Hello traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we'll be talking about the bearish 3-star pattern, which is a rare but highly reliable reversal formation that occurs at market tops. And this 3-candle pattern serves as a clear warning sign that an uptrend may be exhausting itself, potentially leading to a significant price decline. You will learn exactly how to identify this pattern, understand its psychology, and most importantly, how to trade it effectively with proper risk management. So without wasting any much of your time, let's get started. So let's start with the pattern overview. The bearish 3-star pattern forms at the peak of an uptrend consisting of 3 consecutive doji candles that signal a potential reversal. When you spot this formation, pay close attention. It's telling you that buyers are losing their grip on the market. So the first doji emerges when the market is still climbing, showing I'm gonna edit the colors. Sorry. The first doji emerges when the market is showing signs of buyer exhaustion. This candle has a small body, indicating that neither buyers nor sellers could push prices significantly in either direction. Now the second doji gaps above the first, maintaining the upward pressure. However, this gap up followed by another doji is crucial. It shows that despite higher prices, buyers couldn't maintain control of the market. Let me just edit the colors of this. Right. Finally, the third doji appears, often gapping down or opening near the close of the first doji, and this completes the pattern and suggests that the upward momentum has completely stalled. What makes this pattern particularly significant is its rarity. When you find all 3 dojis aligned properly after a strong uptrend, you are looking at a high probability setup that often precedes substantial price drops. Remember that the key to identifying is a valid bearish 3-star lies in the positioning of these dojis. They must appear after a clear uptrend, and the middle doji must gap above the others. And this precise arrangement is what gives the pattern its predictive power. So let's quickly look at the charts to spot one. Remember, this is a very rare candlestick pattern, and we are just looking to find. I found this example, so I'm going to use this example to explain the bearish 3-star candlestick pattern. So this is it right here. We have the first doji, which is this green candle right here. Let me just zoom in a bit. Have the first doji, this small green candle, followed by this red candle right here. It's a big candle, and you can see the gap up between the first and the second doji. There we have this gap between the opening and closing prices of the 2 doji candlesticks. We have a small gap right there. I'm just gonna zoom in for us to see it. We have a gap between the first candle's close and the second candle's opening. So then the next candle is the third doji, which is a bearish candlestick, a bearish doji candlestick, and it also pushes prices a little bit lower, showcasing that indeed sellers are stepping into this market and it's showing buyer exhaustion. So when you see a pattern like this on your charts after a push to the upside like this one we had here, it could signify potential market drops in place or brewing, about to start. So let's talk about the trading strategy. How can you trade the bearish 3-star pattern with precision and proper risk management? Your success with this pattern depends on following a systematic approach. So let's talk about how you can trade with the bearish 3-star candlestick pattern. The optimal entry point comes after the third doji completes. You have 2 entry methods to choose from. The conservative approach is to wait for a bearish candle to form after the pattern, placing your sell order at the close of this confirmation candle. And this confirmation candle should close below the low of the third candle. So we didn't exactly have a confirmation candle after the bearish three-star candlestick pattern. The confirmation candle closing below the low of the third candle happened right here. This candle right here. So after this candle, we'll be looking to enter our trade because it now shows that our sellers are indeed in this market and we should be looking to sell. In most cases, people who traders who like to trade with the top-down analysis, as we see the close below the third doji, you could just go to your lower time frames and look for optimal entries from that area. So let's talk about stop losses. Your stop losses goes above. So we enter a short trade here. Your stop losses goes above the highest point of the middle doji, and this placement is crucial because if price moves above this level, the pattern is invalidated. Never place your stops closer than this. Doing so risks getting stopped out during normal market fluctuations. Now, for your profit targets, you want to look at previous support levels, or you could also set at fixed risk to reward ratio, giving you a minimum of 1:2 risk to reward ratio, or you could just target a 1:3 risk to reward ratio. You could also target significant support levels like this one. So that is how you can use the bearish three-star candlestick pattern to trade. Remember, it's a very rare candlestick pattern, so when you spot it, there are certain indicators you should use for your confirmation. Let's talk about those indicators. The first is volume. You should use volume to confirm your trades. So I'm just gonna add the volume indicator to our charts. Now you should watch the volume during pattern formation, declining volume during the three dojis, followed by increased volume on the breakdown provides additional confirmation of pattern strength. So you can see, as we had this area, this was where we had the candlestick pattern, and you can see minimal volume around this area, little volume around here where we had the candlestick pattern. But as soon as we started having the breakdown of that area, we started having increasing volume from here. So they have an increasing volume, showing us that sellers are entering the market and we should be looking to sell. We should be looking for sales. You could also use your RSI to confirm your trades. You could use your moving averages to confirm your trades. Also, you could use price action to confirm your trades, and price action is my favorite. Looking at this market, you can see that we are clearly bullish, and this was just a pullback into support levels. So if we want to trade this pullback, we'll just be looking at key levels from this area. Like here is a major key level, so we could just mark out our zone. And so going back to the candlestick charts, you can see this is a major key level, and price reacted off it from here where we had our candlestick pattern. And this is an indication that we may be looking to pull back from this area back into support. We had a double bottom right here, so we'll be looking for price to come back into this area of support and give us a push to the upside. So to catch this pullback trade, we were able to catch it using the bearish three-star candlestick pattern which we had there, combined with volume and also price action. So the pattern becomes even more reliable when it forms near key resistance levels or psychological price points. This area naturally attracts more sellers, increasing the probability of a successful reversal. Your position size should never risk more than 1% of your trading account. Calculate your position size based on the distance between your entry and stop loss. This ensures you can withstand several losses without significant account damage. So right, traders, you've come to the end of today's video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.